As you probably know, if you've been watching this channel, I've long been a proponent of a one ETF investing strategy, as I like to keep things as simple as possible. But given what's going on around the world right now, after Trump announced massive tariffs across the board, sending markets into free fall, a growing number of investors are wondering if this still makes sense going forward. So, has a global one ETF strategy run its course and should we now consider something else instead? Let's try to answer this question in today's video based on available data as well as the pros and cons of this investment approach. I'll of course also show you how my own ETF portfolio has been performing lately. Spoiler, it's pretty disgusting. And we'll finish things off with what I'm planning to do and focus on regarding my investments. Okay, let's start with a look at our portfolio and what's going on right now. You may have noticed that the stock market has not been doing too well lately. Within only 45 days, global ETFs like the FTSE All World have dropped more than 17% from their all-time highs in euros. This largely happened as a result of Trump's announcements regarding tariffs, many of which were significantly higher than expected. Even little-known places like Heard Island and McDonald have been hit with a 10% tariff, and I've heard that the penguins that live there are very upset indeed. All jokes aside, our portfolios as European investors have been hit even harder, by the euro gaining 6.7% in value against the US dollar since the start of the year, which in turn made US stocks less valuable in euro terms. Okay, now let's finally take a look at the ETF portfolio shared with my wife in actual numbers and see the damage as of April 4th. We're down 13%, so minus 59,400 euros over the past month, and 14.8% or minus 69,200 euros since the start of the year. The last time the market dropped this quickly was during the COVID crash in 2020, and when we compare our monthly returns back then to now, we can see they were surprisingly similar. As for our average rate of return since we started investing in 2017, that has now dropped to 9.26% per year. It sure feels like one of those times where it's best not to look at your portfolio for a while, which is of course easier said than done. Sadly, these nasty corrections or even crashes are part of investing in the stock market, which is why it's so important you remember to treat ETFs as long-term investments. But when you're in this situation, it never feels like the previous time the market dropped, and your emotions will always find ways to rationalize that this time is different and you should sell, as everything is going down the drain for sure this time. If history is any indication, that's likely to be a costly mistake though. So staying the course as well as adding to your portfolio on an ongoing basis throughout these uncertain periods is likely to pay off even more over the long run as you're able to buy in at discounted prices. Still, I completely understand if some of you are questioning your strategy right now, especially if you only started investing recently. So let's now examine the following question. Is the one ETF strategy dead? Does my preferred way of investing, namely via a single global ETF like the FTSE All World, MSCI All Country World or Prime All Country World, still make sense in the current environment? Or should we be looking for alternatives? While I can't and won't tell you what you should do with your own money, here are a few key reasons why I personally believe this approach is far from outdated and likely to perform better over decades compared to most alternatives which are a lot more complex. Before we get right to them, you can find my favorite low-cost brokers in Europe for ETFs linked down below in the description, which is a great way to support me as I don't do sponsors on this channel. First, the KISS principle. KISS stands for Keep It Simple, Stupid. It's a reminder to stop overcomplicating your investing strategy. This means sticking to simple, historically proven strategies like globally diversified index investing via ETFs, cost averaging, not trying to time the market, and focusing on the long run instead of reacting to short-term noise. The reason a KISS strategy tends to work better than others is because it's easier to follow consistently through ups and downs, and it reduces the chance of emotional or irrational decisions. Even though it certainly doesn't feel like that right now if you check Reddit. Here's what you don't do as a keep it simple investor. Jump in and out of stocks that are hot right now, including European defense companies, buy 10 different sector ETFs just in case, based on what's going on at the moment, or overanalyze the macro environment to try and predict the next crash or recession. As you're focused on the long run, you just keep buying stocks from all across the world based on their market cap via an ETF, and you don't have to waste any time on rebalancing, at least not within the risky part of your portfolio where you're investing into stocks. The ETF does it for you. As some stocks grow in value, their share in ETF increases, while the opposite happens with those that drop in value. Your ETF is self-cleansing. Over time, new innovative companies that are growing quickly are added to the index, while other companies that perform poorly are removed as their market cap shrinks below a certain size. Second, tax efficiency. Another major advantage of a one ETF strategy is tax efficiency, which is particularly important for us European European investors. In most European countries, every time you sell an ETF or stock at a profit, you realize a taxable event, with the government taking a portion of your gains via capital gains taxes. When you use a simple one ETF strategy and just keep buying shares over time without selling, you're essentially deferring those taxes into the future, allowing your money to compound more efficiently. Think about it this way: if you're constantly switching between different ETFs and individual stocks, or trying to time the market by selling high and buying low, which is incredibly difficult to do consistently, you're giving away a portion of your capital to tax authorities with each transaction. In contrast, with a simple one ETF buy and hold approach, you're letting your money work for you undisturbed by taxation until you actually need to withdraw it, which could be several decades from now. There are of course differences depending on the country you're based in, so I recommend checking out this video right here if you haven't seen it yet. Third, market timing doesn't work most of the time. A lot of arguments I'm seeing against the one ETF strategy right now are essentially based on market timing predictions. US stocks are going down the drain right now with the current leadership. You should move everything to European stocks, only buy gold which has been going up, etc. The problem is that market timing has been shown time and time again to be incredibly difficult, if not impossible, to do successfully long term. In fact, most investors end up significantly underperforming a simple market index over decades because they try to time the market. Most gains are made within just a few days each year, so if you exit stocks right now and try to time your way back in, you're likely to miss the rebound. If you missed the market's 10 best days over the past 30 years, your returns would have been cut in half, and missing the best 30 days would have reduced your returns by as much as 83%. Those best days often come right after the worst days when most people already panic sold. This is why a systematic approach to investing, like regularly buying a global ETF no matter the market conditions, tends to outperform market timing in the long run. The fourth reason why a simple global ETF makes sense in my view is its diversification. Just to clarify, I'm talking about diversification within the stocks portion of your portfolio. Obviously, you can still diversify further via real estate, bonds, cash, gold, or even Bitcoin, depending on your personal preference and risk tolerance. The beauty of a global index like the FTSE All World is that it gives you exposure to several thousand companies from all across the world, including emerging markets. Yes, right now the US still makes up about 61% of a global index, which some people are concerned about. But remember, this percentage isn't fixed. It simply reflects the relative market cap of different regions. If US stocks underperform relative to the rest of the world, the share of the US will naturally decrease and other regions will make up a larger percentage. The index, and thus the ETFs covering it, adjust automatically. This is much more efficient than trying to shift your allocations based on predictions or events, which often leads to buying high and selling low. Okay, but can't you get better returns with other ETF strategies? Absolutely, I can't predict the future either. For example, I've seen a lot of arguments for only investing in the American S&P 500 index over the past few years. But interestingly enough, many of these voices have gone surprisingly quiet lately. And yes, a perfectly timed allocation across multiple ETFs could outperform a global ETF. But that's exactly the problem. The right timing is very difficult to achieve in practice. Studies consistently show that simpler portfolios often outperform more complex ones over time because they're easier to stick to. At the end of the day, the best investing strategy is the one you're able to follow consistently through good and difficult periods, like the one we're in right now. Now, to be fair, there are situations where using multiple ETFs can make sense. First, if you're approaching retirement, you may want to reduce risk by adding money market funds, bonds, or other less volatile ETFs. Second, if you just realize that crashes like the one we're currently experiencing are a lot harder to deal with than you initially thought, then you may want to consider adding something like a Euro money market fund like the popular Xeon, or to increase your cash position on a high-yield savings account to make these situations less painful. And lastly, if you simply prefer having more control over how your money is allocated, then holding several ETFs with each covering a different region, for example, can make sense as well. That being said, if you're young, have a long time horizon, and can stomach the volatility throughout your holding period, a simple global one ETF strategy has historically been an excellent way to maximize the likelihood of good long-term returns. Again, as long as you're able to stick with it. As you can see, that's not always easy. So here's what I'm doing with my ETF portfolio during these turbulent times. I decided I'm not looking at my portfolio or the news every day, as it makes zero difference. The reality is I'm not planning on spending this money anytime soon, so it really doesn't matter where it stands on a month-by-month basis. My wife and I will continue to do what we've been doing for the last 8 years, by simply investing in a single global ETF, in our case the FTSE All World, on a monthly basis. We're not trying to time the bottom or to predict when the market is going to recover. We're simply sticking to our long-term plan, aware that historically, Being patient in these situations has always paid off when looking back. All we know is that our ETF is currently on a steep discount compared to a few months ago, so we'll try to treat this as an opportunity instead of something negative. In fact, both of us are looking for ways to grow our income this year to further increase the amount we're able to invest. But don't worry, this does not mean I'm going to start milking you guys. This channel will remain free of sponsored content, and I'm also not going to start selling you overpriced courses you don't need. You can, however, still support me by using my links to my favorite low-cost brokers in Europe for ETFs down below in the description if you'd like to. And don't forget to gently tap the like button and to subscribe if you haven't yet. Speaking of brokers, I recommend watching my comparison for 2025 next, where I also discuss some great options to earn interest on uninvested cash, something I'm going to cover in even more detail in an upcoming video. As usual, none of what I mentioned today was meant as investment advice. I'm just openly sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching, have a wonderful day, and until next time.